Hi, my name is Ravi. Welcome to my channel, Payment Talks. Thanks for the overwhelming response for the payment lifecycle video series. With your support and renewed energy, I am presenting the one of the most important topic and most misunderstood topic of payments in terms of complexity, that is accounting entries during a payment. Every payment, no matter how simple, triggers a series of accounting movements behind the scenes. When a customer sends money or receives money or a transaction fails, these actions are not just operational events. They are financial transactions that must be recorded with precision. This is where double entry bookkeeping becomes the backbone of the payment processing. It ensures that every transaction has two sides, a debit and a credit. In fact, for every financial transaction, the sum of debits should be equal to sum of credits. This dual entry ensures that for every inflow, there is a corresponding outflow. This creates a self-balancing ledger system. What if sum of debits is not equal to sum of credits? Here, two possibilities. First, debits are less than credits. It means the inflow funds are less than outflow funds, which means money got created. Who will account for this extra money that got created and processed further? Second, debits are more than credits. It means the inflow funds are more than outflow funds, which means money is vanished. Who is taking this missing money that got disappeared during processing? That's why this double entry bookkeeping is critical in the payment ecosystem, where high transaction volumes demand precision, auditability, and consistency. Few other reasons why we need this principle is to maintain financial balance, support reconciliation, prevent errors and fraud, enable reporting and compliance, ensure operational control, and improve transparency. Before we move to the double entry bookkeeping entries examples, we need to understand the types of accounts that a bank typically uses in the accounting entries. Understanding these accounts is fundamental in understanding the whole concept. Very important point. Every bank has its own nuance of accounting based on its operating model. The accounts that bank use may be called using their local jargons, but fundamentally they all fall into the categories that we see in this video. If you guys have any other variation, please do comment and let me know. First of the accounts is customer accounts. These are the accounts opened by the customers of bank, whether retail or corporate. These accounts represent the balances held by customers. These accounts are debited when payments are sent and credited when funds are received. These are real accounts. Example, customer current account, savings account, loan account, etc. Next type of accounts is nostro vostro accounts. We have discussed these account types in detail in our previous videos. Just to recap, nostro account represent the mirror account of the bank held with another bank. Vostro account represent the actual account of another bank that is held with the bank locally. These are used for settlement in cross-border or correspondent payments. Next account is clearing and settlement accounts. As we discussed in payment lifecycle video, these are two different processes and they usually are two different accounts. Clearing account is used to temporarily hold payment values during interbank transfers until cleared. These accounts are held by clearing house. To represent the values in these accounts, banks create a mirror or shadow account in its books called clearing nostro. Usually, this account is used to capture the entries when payments are sent and received from clearing. Settlement accounts are held with central authorities like central banks for each of the participating banks. After clearing, the funds will be moved into these settlement accounts of each bank at central bank. We shall cover the full clearing and settlement concept in separate video later. Next is suspense accounts. These are not actual accounts. They are temporary placeholders that each bank create for their processing. The kind of accounts that banks can create suspense account is based on bank's operating model. Funds entries are temporarily parked while payments are getting processed. Sometimes special suspense accounts are created to place fund entries in case payment is incomplete. The speciality of these accounts is that they are zero sum, which means at the end of the day all these accounts should have zero balance. If they have any balance, then it means there is some issue in the payment processing. Investigation will be initiated. After resolution of the issues, these balances will be cleared to make them zero balance. Next is FX reevaluation or conversion accounts. These accounts are used in cross-border multi-currency payments. They record the currency conversions. They also capture the exchange rate movements to finalize FX profit and loss. Next, income and expense accounts. These accounts capture the fees, charges, commissions, interest, etc., which are either income or expense of the banks. They are internal accounts of the bank that hold actual balances. They are real accounts. Example, fee income account, commission expense account, etc. The last type of accounts are virtual accounts. These are sub-ledger accounts created under a main physical account. These accounts help businesses manage and track incoming and outgoing payments more efficiently. The virtual accounts solve many use cases. With evolving fintechs, we have different kinds of virtual accounts. For example, fintechs like Revolut and others give customers multi-currency wallet accounts. These are virtual accounts of different currencies tied to one main account in home currency. Similarly, fintechs like Wise may open one real account in a bank and then they create multiple virtual accounts for each customer they onboard. We shall discuss in detail the ways of working of these fintechs and their payment model in future videos. Now we understand various account categories that a bank can use in accounting entries. Now we shall see some practical examples and understand the accounting entries in more details. We will now cover the example scenarios in detail. For this, we will follow a format. We are going to focus accounting entries in a bank. One side we will have the customer and another side we will have clearing and settlement, which may also include the correspondent in cross-border scenario. The direction of the arrow tells us whether it is incoming or outgoing payment. Each scenario is explained here. Each debit and credit is represented by this box. It will show the amount and currency here, and the account that is getting debited or credited here. As you would have already observed, we represent debits in red and credits in green. Each line represents each step in accounting, which will have a debit and a credit to make sure double entry bookkeeping is maintained. Let's start with scenario 1. Basic domestic outgoing payment with no FX and no charges. Customer transfer 1000 USD to his friend in another bank. This is a domestic outgoing payment, so his friend is also in same country having USD account. The entries that bank would make is debit 1000 USD from its customer and credit the same 1000 USD into the clearing nostro. Here, why is this account called clearing nostro? Because the actual account is with clearing and bank maintains the shadow account to represent the clearing account. Usually in domestic outgoing scenarios, the bank does the accounting entries after receiving the acknowledgement from clearing, just to be sure that there is no communication gap. This is called single step accounting. Here I just want to touch on what happens in clearing and settlement. In clearing account of the bank, there will be a debit of 1000 USD. Please observe that the credit in clearing nostro became debit in actual clearing. This is how mirror accounts work. Debit becomes credit and vice versa. If it was a RTGS payment, this 1000 USD would be credited to the settlement account of another bank. Typically, it would be the bank of his friend. Here, I am using clearing and settlement as one. There are more details here, but I am keeping it simple in this video to concentrate on the accounting postings of a bank. As discussed earlier, we will go in depth on clearing and settlement later. Now let's look at scenario 2. Basic domestic incoming payment with no FX and no charges. Customer receives 1000 USD from his friend. As this is a domestic incoming payment, so his friend is also in same country having USD account. Before the bank's entries, let's focus on clearing entries. The clearing will debit the 1000 USD from sending bank and credit the 1000 USD into the bank's clearing or settlement account. Now bank will debit the clearing nostro opposite of what happened in actual account and credit the customer with 1000 USD. Here if you notice, this scenario is the continuation of first scenario as receiving bank. The customer here is the friend of scenario 1 customer. The bank here is the receiving bank in the first scenario. These two scenarios cover the basic end-to-end customer-to-customer single-step accounting, which involves customer account and clearing nostro accounts in both the banks. Now scenario 3. Domestic outgoing payment with no FX and no charges. Customer transfer 1000 USD to his friend in another bank. This is domestic outgoing payment. Basically, this is same as scenario 1. Let's look at accounting entries. The first entry here would be debit customer 1000 USD and credit general suspense 1000 USD. Many banks does this. The reason is banks processes involve many steps as we have been in the payment lifecycle videos. There is possible delay in any of those steps. So banks first debit customer and park the funds in the temporary suspense account. Once the payment is proper and executed, then second step of entries will happen, which are debit this general suspense and then credit the clearing nostro. Please note here, if the payment is successful, then the balance of the suspense account is 0. 1000 USD came, 1000 USD gone. Net 0. This is called as multi-step accounting. Now scenario 4. This is same scenario as the previous one. Let's look at accounting entries. The first entry is debit customer and credit general suspense for 1000 USD. The second entry is debit general suspense for 1000 USD and credit sanction suspense for 1000 USD. Why do we need to do this step? Some banks does these entries. When the payment moves to sanction system, by having these entries in ledger, it will be clearly evident that those payments are with sanctions. The next entry would be debit sanction suspense and credit nostro for 1000 USD. Here, sanctions is a suspense account, and for a proper payment, the balance becomes 0. In fact, some banks or fintechs want to do the ledger entries at every major step of the payment processing. They can introduce suspense accounts for each department or step that the payment gets processed. In traditional banks, this is not common, but in fintechs, this kind of multi-step accounting is common and crucial for their payment model. Now, scenario 5. This is same scenario as the previous one, but payment is stuck in sanctions. Let's look at accounting entries. The first entry of customer to general suspense and second entry from general suspense to sanctions suspense are same. As we know, the second entry is made when the payment is processed to sanctions. Sometimes payments will be delayed at sanctions. There is no error or repair scenario. but it's just that payment is stuck in sanctions. For that matter, any department where we have configured for these suspense accounts. At the end of the day, when you see the suspense accounts balance, you have some balance in sanction suspense. This will clearly indicate that some payments are stuck in the system and are not processed STP. This is real use of the suspense ledger entries to understand the payments which are stuck in the system. This is possible right from the usage of the general suspense to any kind of suspense accounts that bank may want to use. Now scenario 6. This is same scenario as the previous one, but the payment here got repaired during the processing. Let's look at accounting entries. The first entry is to take funds from customer and park the funds in general suspense. During processing, the payment got repaired. At this stage, just by looking at the entries and balance in general suspense, we can understand that there is a problem with some payments in the system. Some banks want to separate the payments that are having the problem to investigate and resolve. So they move these funds to separate queue like operation suspense to work on and then clear the funds once the issue is resolved. Most common case is the sanction seize. When there is a hit in sanctions, some banks have to seize the funds and report to the regulatory bodies as per the country's law. In those cases, the funds will be moved to separate temporary account called sanction seize. Like these, each bank can configure many use cases. Scenario 7. Now we will move to cross-border scenarios. This is a cross-border outgoing payment with no FX but charges. Customer transfers 1000 USD to his friend in same currency to another bank in another country. How customer can decide the sending currency as USD? We shall see this in ISO Pay-in-1 video. Here, one point to note is the clearing and settlement is correspondent bank. The actual settlement may happen in this bank or in the correspondent bank, depends on the relationship between this bank and correspondent bank. We have already covered this concept in the previous correspondent banking and nostro-vostro videos. Let us now see the accounting entries. First step would be to debit the customer and credit the general suspense with 1000 USD. Let's assume the charges are 10 USD. Please note charges usually are charged in the home currency. Here in this scenario, the home currency we assumed is USD. The second step is debit customer of this 10 USD and credit the general suspense. In this scenario, two steps are debiting and crediting the same accounts. In other scenarios, we can do this as single step of 1010 USD, but in this scenario we cannot, because customer is being charged on top of the instructed amount. So that has to be a separate entry so that it is good customer experience without confusion. If you do single entry of 1010 USD, then customer would be confused. Now the third step is to move the fees of bank to its fee account as profit. The entries are debit general suspense and credit fees P&L account with 10 USD. The next step is to debit the instructed amount 1000 USD from general suspense and then credit correspondent nostro-vostro account. If the correspondent account is nostro, then it is mirror account of the actual account of the bank held at correspondent. So the settlement, that is actual movement of funds, is not yet done, and the bank will send the payment instruction with settlement code INDA asking the instructed bank to do the settlement. If the correspondent account is vostro, then it is the actual account of the correspondent held locally with bank. So bank will move the funds into the vostro account. The funds movement is done. Settlement is done. Now the bank will send the payment instruction with settlement code INGA, meaning I as instructing agent already settled this payment funds into your account. Now you please process this payment further as per the instruction. Next we move on to scenario 8. This is cross-border incoming payment with no FX but charges. Customer is receiving funds in USD from his friend from another country in same currency. The payment is received by the bank from its correspondent. The first step here would be to debit correspondent Nostro Vostro account and credit general suspense with 1000 USD. The concept of Nostro Vostro is explained in previous scenario and it is same here but as a receiving bank. Assume the charges here are 10 USD where home currency is also USD. The charges are taken from proceeds. Why the charges are taken from proceeds is already explained in the previous video of our Ben Shah charge codes. Please watch that video for more clarity. The next step of entries would be debit general suspense with 1000 USD and credit 10 USD of charges into fees PNL account and remaining 990 USD into the customer account. Please note the accounting principles here. Sum of debits is equal to sum of credits with same amount and in same currency. Next we move to scenario 9. This is cross-border outgoing payment with FX but no charges. Customer transfers 1000 USD to his friend in India to INR currency account. This is a FX scenario. FX concept in itself is a big topic to be discussed and we shall cover this in separate video. Here we focus only on accounting entries with quick introduction to some points to understand the accounting. In this scenario, FX happens in the debtor agent bank. We call this debit side FX. The first entry is debit customer and credit FX suspense with 1000 USD. Here you can add another step to have general suspense in between. As we have already covered many general suspense scenarios, I am skipping that and focusing on FX only. The conversion is from USD to INR. Assume the market rate is 1 USD equals 88 INR. Understand this carefully. FX is one of the major profitable businesses of any financial institution. Bank will apply their margin on top of the market rate and give the FX rate to customer. In typical FX world, you have many jargons like bid rate, ask rate, spot rate, forward rate, mid rate, buy price, sell price, basis points, margin calls, etc. Here we will not go into those jargons but understand the concept in simple terms. In this scenario, customer is giving USD and asking for INR to be sent to his friend, which means banks takes USD from customer and gives INR. Here bank takes some margin, right? So they give less INR per USD to customer. Now bank will give a rate of anything less than 88 INR per USD. Assume bank rate is 86 INR per USD. This is the rate at which customer amount will be converted. So the conversion is 1000 USD becomes 86,000 INR. So the next entry would be debit 86,000 INR from FX suspense and credit 86,000 INR in correspondent Nostro Vostro account. The FX account here is not exactly suspense account, rather it is a re-evaluation account, which means from suspense perspective 1000 USD equals 86,000 INR, so the balance, making proper STP transaction. But on what basis does this conversion happen? Here is where bank's treasury team comes into picture. Bank might have got 88 INR per USD, but they gave 86 INR to customer and take the 2 INR per USD profit. So there will be counter entries against this conversion separately by treasury. They are out of scope for payment but in scope for bank. The FX rate when given to payment engine for conversion, it has a booking entry reference from treasury. End of the day, treasury and backend operations will reconcile the FX suspense or re-evaluation account and finalize the profit or loss incurred in FX. Why are we talking about loss here when the banks adds margin? In reality, bank does not exchange the currencies for every transaction. They do bulk deals. Then they use the liquidity to process FX payments. Sometimes due to unexpected reasons, bank may give a conversion to customer, but when they actually convert, rate might be down, that may incur loss. But this rarely happens and bank always hedge such risks. Next we see scenario 10. This is cross-border outgoing payment with FX but no charges. Here the customer transfers 86,000 INR to his friend in USA to USD currency account. Here I want to show what if the receiver in the previous example tries to send the 86,000 INR that he received back to his friend. Our basic institution is that friend in USA should receive the 1000 USD back, right? Let's see if that happens. This is also debit side FX scenario. The first entry would be to take from customer. Debit 86,000 INR from customer account and credit to FX suspense. Market rate is 1 USD equals 88 INR. In this scenario, customer is giving INR and asking to send USD. That means bank is taking INR and giving USD. So this time bank will ask more INR per USD. Assume the bank rate is 1 USD equals 90 INR. Again, I'm not going into direct rate, indirect rate concepts, rather trying to explain in plain language. So the 86,000 INR, if converted into USD at bank rate, will become 955.5 USD. So the next entry would become debit 955.5 USD from FX suspense and credit 955.5 USD to correspondent nostro vostro. In short, the 1000 USD which was sent had become 955 USD when returned with a 45.5 USD vanished in the conversions. What did we understand here? The traditional cross-border businesses and FX conversions are expensive business. With less competition previously, the banks had a very good business model for revenue. Seeing this gap, we have fintechs like Wise, Revolut, Remitly, etc. have come into market with a new cross-border payment model where they do not actually transfer money incurring the FX expenses, but they do settle the amount in various countries in different currencies. As their model does not actually move the money, they are able to give better exchange rates to customers. Hope this explanation gives a precursor to the fintech cross-border payment model, which we will cover later. Next, we shall look into scenario 11. This is cross-border incoming payment with both FX and charges. Customer receives funds into INR account from his friend in USD, sending from USD account. Here the FX happens at creditor agent. This we call as credit side FX scenario. As I already mentioned, how does FX happen at debtor agent or creditor agent and how is this controlled? We shall look into this concept when we cover ISO PAIN 1. For now, let us look at this scenario where USD reached to the bank and bank needs to convert into INR to credit customer INR account. The first entry is debit correspondent nostro vostro for USD 1000 and credit it into FX suspense. Again, I am skipping the general suspense step here, focusing on FX and charges. Market rate is 1 USD equals 88 INR. As the conversion is from USD to INR, the bank rate would be 1 USD equals 86 INR. Bank home currency is INR, so the charges would be in INR. Here we are keeping it simple where customer account is in home currency. There will be complex scenarios where customer account will be in different currency than home currency, which we cover in the last scenario of the video. Assume charges are 100 INR. Now the entries would be debit the converted 86,000 INR from FX suspense and credit 100 INR into fees account and remaining 85,900 INR into customer account. Again, sum of debits equals sum of credits. Now we come to last scenario 12. This is a cross-border outgoing payment that involves FX cross currency with no charges. Customer in UK transfers funds from USD account to his friend in France into euro currency account. The customer and bank are in UK and the home currency here is GBP. Here we are making following assumptions to explain cross currency concept. Bank does not have direct FX conversion from customer account currency USD into instructed currency euro. This case usually happens with the exotic currencies. In our scenarios, we have taken major currencies only. Next is we are trying to cover a scenario where the banks want to always convert the foreign currencies into home currency for FX. This is mainly for the bank's operational purposes where they report their financials in the home currency. Okay, now coming back to our cross currency scenario. The FX rates are 1 GBP equals 1.3 USD and 1 GBP equals 1.1 euro. I am not complicating this scenario with margins, but in real world scenarios margins exist and that is revenue for bank. I am starting with 1300 USD as the instructed amount for simple calculations. First entry would be debit customer USD account with 1300 USD and credit 1300 USD into FX suspense. Again skipping the general suspense entries. This USD will be first converted into home currency GBP. The second entry would be debit 1000 GBP which is converted 1300 USD from FX suspense and credit 1000 GBP into FX suspense. You might wonder why debiting and crediting the same currency into same account, right? But we need to understand that this is FX re-evaluation account and every conversion needs an entry to counter the treasury conversions. The third entry would be debit 1100 euro from FX suspense and credit 1100 euro into correspondent nostro vostro. Please observe the following here. In each step, the debit and credit always happen with the same amount or sum of same amounts and the same currency, thereby upholding the double entry payment accounting principles. With this, we come to the end of this video and hope that this video gave you some new learning. In real world, we may face many unique and different scenarios. I hope with the learnings that you got in this video, you can tackle them easily now. Thanks for watching this video. If you like this video, please like, subscribe and share for more such interesting topics on payments.